Hi, everyone. After the plunge in the stock market this morning, I'm sure there are a lot of people that are concerned out there. So I wanted to talk to you and tell you what's going on. Today is March 9th, 2020, and the stock market plunged over 7% at the open in response to the coronavirus. And that hit the circuit breaker, and the market was halted for 15 minutes to kind of let everybody catch their breath and prevent a free fall in stock prices. And that's exactly what happened. As soon as the halt was over, the market has bounced a bit. So that's a good thing. Now we're down only 5.3%. We were down over 7%. So we're getting the desired effect from the halt. But I'd like to talk to you about the stock market overall and the implications for investors and what's happening with the coronavirus. Because I've done some research lately over the weekend to try to determine what the long-term economic impact is going to be and how that's going to affect investors. So let me talk about that and let you know what I found out. I apologize for my wheezing. I have asthma. So what's happening is that investors hate uncertainty, and there's a lot of uncertainty happening with the coronavirus. It's a brand new strain of the influenza virus. And so people are not quite sure what to make of it and what's going to happen. That includes the medical health professionals. Now, what we know about the coronavirus is that it's, first off, very contagious. You can be within 3 feet of someone and they don't even have to cough or sneeze, and you can catch the virus. So it's pretty much inevitable that it's going to spread quite a bit, although medical health professionals are trying to prevent that the best that they can, but it's pretty much inevitable. It's going to spread. With the coronavirus, based on what I've seen so far, even though it's very contagious, it only actually kills about 0.2% of people. So that's not really what's going to have the economic impact. What's having the impact is everybody's response to try to avoid it. For example, right now in Italy, I heard on National Public Radio this morning that about 15 million people, or a quarter of the population of Italy, is under quarantine, under lockdown, basically house arrest, where everybody's staying home trying to avoid the spread of the virus. What happens if you get the virus? It's like a bad case of the flu, and you can get very sick. And the people who are going to die are people with weak immune systems, like the elderly or someone who's got, some other health problems. But the economic impact comes from the response to trying to prevent the spread of the virus. That's what's happening right now. So obviously, the impact in Italy is going to be huge if a quarter of the population is under lockdown and trying to avoid the virus. Also, there are going to be pretty high expenses in healthcare related to treating people because, if people are very sick with the flu, a lot of people aren't going to just stay home. They're going to go to the emergency room for treatment. And that's what I'm hearing in Italy and China and in certain places in Washington and the United States. We've got emergency rooms and treatment centers that are at capacity, okay? And so that's going to have an economic impact. Now, the real potential danger for a pandemic is if the virus mutates. I did some research on the 1918 Spanish flu that killed somewhere between 17 and 100 million people. They don't really know. But a lot of people got sick. And the reason why there were so many deaths back then is because of the unsanitary conditions and the large hospitals filled to capacity with soldiers from World War I. The Spanish flu hit right at the very end of World War I. It wouldn't have killed so many people if it weren't for specific conditions related to the war, like lots of men and soldiers in the trenches, stuff like that. And so the Spanish flu killed between basically 1 to 2.5 20% of the people that it infected. And because it infected so many people, that's why you got millions of people who died, because of conditions and because of the higher percentage. By comparison, the coronavirus is very contagious and it will spread, but at the moment, it's only killing about 0.2%, which is roughly the same as the flu. So right now, it's going to have an economic impact. It's not going to, percentage-wise, kill a lot of people, but still, it's going to have an economic impact. Now, let's look at the market here. Let's, need to see me or my virtual backdrop. So let's lower that. Now, this is what's happened right now. As of today, the market has dropped 19% from the high on February 12th down to the lowest price this morning. 19%. 20% is a huge line in the sand. It's the cutoff. Okay. This is what happened a little over a year ago in December of 2018. The high came right here on October 3rd, and we were holding prices pretty well until December 3rd. Then the market sold off hard and went down 16% just in the month of December, and a total of 19% from the high on October 3rd. And you see from that point that the market came back and has rallied since then. And we went on, seeing the big picture here, we went on to much higher highs. Here we are dropping to a low of 19%. Right now, it looks like the market is going to snap back and go back to higher highs. But here's something to consider for the long term. This is for the short term. I think it will do that. I think it'll bounce back up to 27, 28, 29,000 on the Dow. But here's what's going on for the long-term view for investors. Keeping in mind, number one, the Fed just lowered interest rates by 50 basis points. They did that mostly, the excuse is the coronavirus, and that's true, but a lot of it has to do with Trump trying to get reelected. He's putting as much pressure verbally and publicly as he can on the Fed to lower interest rates. Why? Because that improves his odds of getting reelected. The history shows that the president is much more likely to get reelected if the economy is still strong on the election year. That's why historically, the election year and the pre-election year tend to be very good in the stock market. And if there's a crash that's going to come, it's going to come the year after the election. Okay, so with the coronavirus, with these stats about presidential elections, and with the fact that we're already at nosebleed prices and the market is well overdue for a correction, a bear market, then that leads me to believe that the market is going to crash next year in 2021, or maybe at the very end of this year. The corporate profits in the economy were already slowing down. The coronavirus is only going to make it slow down more. Okay, so for long-term investors, now is a really good time to start thinking about selling. And if we start to go down below the 20% level right now, then you should think about selling all your stocks, because it's likely to go down further. The bear market that happened from 2000 to 2002, the S&P 500 dropped 45% before coming back over about a 2-year period. From 2007 to 2009, the S&P 500 dropped 55% over a year and a half. Now, like I said, I think the market's going to bounce here and come back up, but sometime within the next year, it's very likely to start the bear market. And I'm predicting, based on my proprietary models, that the market's going to go down on the S&P 500, 55 to 60%, because we're in a bubble, because the Fed has put in the the lower tax bill. All of this has done so much unprecedented stimulus that we're in a bubble, and the market's going to fall at least as much as it has in previous bear markets. That's why I'm predicting 55 to 60% drop from the highest point when the bear market comes. Further evidence that this is going to happen is the inverted yield curve that came out last year and has happened a couple times since then. My studies have shown that the bear market starts about a year to a year and a half after the inverted yield curve shows itself and appears. So there's a lot of evidence mounting that the big sell-off is going to come. Pardon me, that's my yellow lab in the background. So that's what's going on, and you need to be aware of that. I do my best to help investors to understand what's going on. That's what I do for a living. I teach people how to make money in the stock market and how to avoid losses. There's a huge lack of knowledge about this in the United States among the average investor, and I am doing the best I can to teach people that. I'm starting to do group presentations to companies and organizations. Up to now, I've pretty much done single coaching, one-on-one over Zoom or Skype, and you can be anywhere in the world for that. But if you have money, I would highly recommend that you learn more about what you're doing in the stock market, and I can help you with that. You can send me an email if you want more information about this. My email address is TraderGreggK, G-R-E-G-G, and the letter K at gmail.com. TraderGreggK at gmail.com. Now, keep a close eye on the Dow Jones Industrial Average right now. If it starts to drop below the 24,000 mark and keep going down, then that means the bear market's probably starting right now. So keep a close eye on that. Don't be an ostrich, stick your head in the sand. Keep an eye on what's going on. Be informed so you don't lose a lot of money, because if it starts trending below the 20% mark, it's likely to go another 35 to 40% down from the highest price, okay? And then it'll take years to overcome that, 4 or 5 years to come back to reach break even, at least. So don't let that happen to you, okay? Keep an eye on the markets and be prepared to sell. This is Greg Kilpack. I hope that helps. If you have any questions or comments, please put that in the sections below. Please comment, please like this video, and please share this information with your friends and family so they don't have to take big losses in the stock market too, okay? I hope that helps. Have a great day, and I'll talk to you soon.